Hello and welcome to what is actually my first webinar ever, out of my comfort zone. So I'll do my best with it, and let's just see how we go with it. So the webinar's entitled "Get Set for 2021." So even though we're already into February, many businesses are likely to still be focused on the events of last year, the impact it's had on their finances and where they stand in their particular markets. We've certainly noticed that there have been winners and losers during the whole pandemic situation. And although I was one of the first to say that reviewing past performance is important, it's arguably even more important to look to the future as we all rebuild from what I would like to think is this once-in-a-lifetime COVID catastrophe. So it's always much easier to make the most of new opportunities or dealing with challenges when you understand your finances. As Sunny accountants, we certainly found that the businesses that achieved the most success in 2020 were those that were able to either diversify or even reinvent themselves fairly quickly. Sometimes it was as simple as renting out a commercial building that was formerly used for a declining business. But we've also seen clients that have started a completely new online business from scratch. So to help you get set for 2021, we're going to look at 5 key elements that businesses need to consider. So the first thing we're going to look at is how to implement real-time accounting data. First of all, you might be thinking, what is real-time accounting data? Basically, it's information that's in the here and now rather than the traditional way of looking to set up accounts that the events in those accounts have already happened. So the world's changing quickly, and nowhere is this clearer than the advancement of financial technology, especially cloud accounting. I totally appreciate that many businesses may be concerned about investing in these uncertain times. But if the last year has demonstrated anything, it is that those that have innovated have a higher chance of success. So what are the benefits of real-time accounting? Well, I was reading an article from Xero, the online bookkeeping company from New Zealand. For those that are not aware, they've been tremendously successful in a short space of time in the UK. What they found was that most small businesses considered real-time accounting from their accountant as an essential part of their survival. Apparently 45% of owners said that advice and information from their accountant is more important to them now than ever before. Going on, 63% said that the systems employed by the accountant have been essential, and 33% of SMEs revealed that the pandemic led their accountant to adopt new forms of cloud-based technology. I think it's the case of having to. Implementing real-time accounting by the likes of Xero, QuickBooks, for example, allows you to keep track of every single transaction in and out of your business and identify areas that are doing well and those that you're required to make some changes on. By empowering your businesses with this information, you should be better equipped to make quicker, informed decisions. Remember the adage, time is money, it still rings true, especially in the hectic modern work environment. So what are the elements of real-time accounting? Well, first of all, profit and loss account, probably familiar to a lot of you. It's usually in the P&L that businesses see the most value in their real-time accounting data. It really is just a click of a few buttons and you can immediately see what your profits are, or indeed losses, what they're looking like. A couple more clicks and you can compare to previous years. This is something I personally use a lot, especially when trying to keep a lid on the stationery bill expenditure. So, unlike old school accounting, there's no waiting for the month end. The info's there, 24 hours a day, wherever you may be in the world. Back in the day that we were actually allowed out of our own country. Having this data can be really useful. Maybe the bank manager's asking for figures, or you're trying to secure an increased credit limit with a supplier. So, spotting the signs. Running a business can be a fickle task at times, and it can be difficult to ascertain exactly how well or not you are doing before you receive a regular set of accounts. By using real-time accounting data, you can instantly see the impact of any changes you make. There's no waiting for figures, they're there in front of you and can be shared with other key stakeholders, allowing you to adapt your strategy as necessary. For example, you may sell a lot of goods on Amazon and feel it's working really well for you because so much of your turnover is generated that way. But in reality, your actual profit may be really low after Amazon, etc., have taken their call. So we can use the software to separate each income stream, separate the costs associated with each income stream, and very easily track margins, thus enabling business decisions to be made very quickly. Equally, by having a handle on your finances, you can spot new opportunities for profitability or see trends that could dictate your investment and lead to the development of popular products or services. Being agile and acting on intelligence about your business will keep you competitive one step ahead of the market. Not only that, but real-time accounting will give you peace of mind and confidence that any time, day or night, you'll have a true, up-to-date reflection of your business accounts. Each company's use of data will vary. It depends on the nature of the industry and the requirements of the business. Likewise, how they implement real-time accounting and how much they invest, that's also going to differ. So, what should we look for when implementing new systems? Start simple and small. If you're new to real-time accounting, research to learn what solutions will work well for you and implement one at a time to monitor the benefits of each service. Expanding the sources of data used. Explore potential users, not only of data available internally, but also of the data available externally. Develop new strategies. Make sure you're effectively using leading-edge analytical techniques and technologies when implementing real-time accounting. Building strong data governance and quality infrastructure. You must ensure data integrity and quality. And seek advice. I strongly advise that you work with advisors that have experience integrating real-time accounting and who understand the various cloud platforms and applications that are on the market. So moving on to understanding the role of management accounts and reporting. I find a lot of clients don't really know or understand what management accounts are. And if they do, they think the business is too small to benefit. Although a lot of business owners are happy reading through a set of year-end accounts, considerably fewer invest in management accounts regularly, meaning they may not get a full or accurate picture of their figures. So what are management accounting reports and why are they so important? Well, a management accounting report gives specific insight into your operations and allows you to judge your business performance going in the next week, quarter or year. They typically contain an overview of your cash flow, the lifeblood of any business, details of how much money has moved in and out of your business, profit and loss for the same period, information on your assets, your liabilities and the equity of your business, and detailed data about your debtors and creditors for the given time frame. So by receiving regular management accounts over various periods, owners can compare their financial performance and find trends that could help them with the future direction of the business. Now, Sage did not make preparing management accounts easy, but no surprise, their own QuickBooks do. To name a couple, it really is really easy and quick to get some management accounts that are meaningful very quickly. So what does a standard set of management accounts tend to contain? They normally start with an executive summary. This will be at the top of the report. You'll see the executive summary for the chosen period. This will show you profitability, your income, and general performance, along with a simple overview of financial information. While some businesses run quarterly reports, monthly ones can be more beneficial to your business. Then you'll often find a cash summary. In this section, you'll see a summary of the cash flows in your business, how much money is leaving, how much money is coming in. Then the familiar sight of a profit and loss report, probably the section that most business owners hone in on first, because it provides details on how much money you've gained or lost during a period. Then you've got the balance sheet. This will provide you with a financial statement showing your assets, your liabilities, and your capital at the point of generating the report. Bearing in mind that's just a snapshot on that particular day. Then you've got your aged receivables or debtors. In this mini report, you'll see any sales, invoices, or receivables that are yet to be paid to your company during this period. Aged payables or creditors. Likewise, the report shows you how much money you currently owe, along with how long this has been the case. And then there'll probably be other discretionary information at the end of that. Most cloud-based accounting software, such as Xero, allow you to incorporate a wide range of information in addition to what's been highlighted above. Seeing all the information you receive from a management accounting report is one thing, but understanding how to use it effectively is another matter entirely. So this is where the advice of a trusted advisor can help. By working with an accountant, you can make timely changes that have a meaningful impact. And this could help you to either lower your expenses, modify your budget, improve profitability, or plan for the future. So moving on to the importance of cash management. Well, as proven by the huge take-up of C-bills and bounce-back loans, cash is still king. It's a safe haven now more than ever. It's very important that businesses manage and maintain good cash flow to ensure they remain viable and can continue to trade. So to manage cash flow effectively, businesses need to be able to forecast how they'll perform. They need a cash flow forecast, in other words. And a well-prepared cash flow forecast can help to predict sales performance, estimate costs and spend expectations, and indicate when cash will come into and leave a business. I run a cash flow forecast for my business, and I'm genuinely looking at it and updating it every day. As a minimum, the business should look to compile a 30, 60, and 90-day cash flow forecast. But longer forecasts can be useful up to a point. Ours runs to the end of 2022, for example. But just be aware that long-range forecasts may be less accurate. They can't predict a pandemic, for one thing. So moving on to preparing a cash flow forecast. Well, the starting point is a prediction of turnover or sales, and they're usually broken down monthly. To create these estimates, and I know it's easier for some type of businesses compared to others, you should look at previous year's sales figures to identify trends or seasonal variations. Most businesses tend to have seasonal variation. Also, don't forget about the introduction of new products or services and the expected market for those. Additionally, if you plan to make more sales in a particular area, build that into your forecast. This should include any new contracts or retained work that's anticipated during this period. At this stage, don't include any tax on products or services sold, but that will come later. The next stage, a profit and loss forecast, combines your business's income and costs to give you a projected profit figure for the future. By preparing this, you should be able to estimate how much tax the business will be liable for, understand the costs of launching new products, and gain an indication of loss-leading products and or the first indications of negative cash flow. Be sure to include costs in the month that you incur them rather than the month that you pay them. Just also bear in mind that all cash flow forecasts are prepared based on payment dates, but a profit and loss forecast must be prepared based on when you incur the costs. At this stage, you can estimate and include VAT costs into the forecast, but large one-off costs should not be included until the final cash flow forecast. So using the information gathered so far, you should now be able to build up an idea of cash flow within the business. and prepare an accurate cash flow forecast that takes into consideration sales, profits, and costs. This shouldn't take up too much of your time, but it doesn't hurt to seek professional assistance to make sure you've included everything and the figures make sense, especially if you think you may be showing those figures to a bank manager, for example. Needless to say, cloud accounting technology has made it really easy to effectively and accurately forecast cash flow and very quick to change things as necessary. Right, so now I'd like to move on to talk about some helpful steps to improving credit control. So an important element of healthy cash flow is, of course, the credit control process. Smaller businesses in the UK, they've always struggled to recover payments, especially from the bigger boys. And to be fair, the government have tried to introduce legislation along the way to try and tackle this, but so far it's been a bit of a blunt instrument, has to be said. Alas, it falls on the shoulders of small business owners to improve their credit control on their own. So to help, we've outlined some of the steps that businesses should consider taking in the coming months to try and improve their credit control. So firstly, create or review existing credit control procedures. Businesses need a clear and coordinated procedure for credit control, and there should be no exceptions to that. It should establish a realistic timetable, including all the stages that need to be completed by various team members within the business, and outline the credit terms that should be based on the needs of the business. So once these elements are in place, the business can then prepare a process for chasing payments, including a schedule for sending reminders, including an initial notice of prompt payment, followed by letters, emails, and phone calls. Quite often do the trick, actually. This process should also establish when it might be necessary to pass a debt over to a reliable commercial debt collection agency. Having a record of this process ensures that all the parties to a sale are aware of the terms and conditions, and it'll also help to reduce any problems associated with late payment before they even occur. Researching new clients. So a small amount of due diligence beforehand can help to streamline the credit control process. Undertaking a simple credit report on a new customer can help to reveal if they've had any issues making payments in the past, and identify which businesses pose the greatest risk to cash flow. Credit checks can be conducted quickly and cost effectively nowadays online, and in most cases you're only going to need a company's full trading name, registration number, address possibly, and also possibly the key contact detail. So undertaking these checks is of course no guarantee of payment, but it does allow a business to make informed decisions about the terms and conditions associated with each transaction. And as part of this review process, it's worth creating a watch list of potential late payers who can be carefully monitored so that action will be taken to prevent late payment. Fostering positive working relationships. So getting paid isn't just a process of making demands or threats. Creating a lasting positive relationship and clear channels of communication can go a long way in helping to obtain timely payments. It doesn't hurt to make courtesy calls, to confirm receipt of paperwork in advance of the invoice due date. It shows the business is friendly and professional and allows a customer to give prior warning of a late payment. Be quick and accurate. It isn't just the responsibility of customers to ensure payments are made. Ensuring your invoicing procedures are effective, that can also make a massive difference. So we recommend that businesses send invoices as soon as orders have been fulfilled. Email or send invoices electronically rather than waiting on the post. Ensure that the invoice is addressed to the right person, whether that's by post or by email. Make sure that there are no mistakes in the invoice. Confirm that the invoice has been received. Acting early prevents delays and helps to build a rapport with your customer. So we could incentivize. Businesses struggling with late payments could look to add incentives to the credit control process. It could be something as simple as offering an early settlement discount to customers that are known for paying late. And that will kick in when they pay within the agreed credit terms. And whilst this may seem like rewarding bad behaviour, it may mean that your business is paid sooner. These incentives can also be incorporated into your pricing structure so that profit margins are not being affected by the discount. We should also look to make payments easier. There's never been more choice when it comes to payment methods, so businesses should make sure that they can offer as many as possible. A lot of these you'll recognise straight away, but they can include BACS payments, credit debit card, payment by cash, online payments, or even direct debits via the likes of Go Cardless. If your business is really struggling in this area, then it may make more sense and actually be more cost effective to seek out professional support. Outsourcing your credit control and cash management to an accountant, for example, it could drastically improve your chances of success. So, I want to talk about the difficulties of pricing next. A lot of business owners do struggle with pricing. It's not unusual for them to price just a little bit lower than the competition. Some of them actually pluck a figure out of mid-air. Needless to say, neither of these approaches is effective in a digital age where consumers can review prices instantly. By failing to grasp the importance of pricing when taking sales online, a business may unwittingly make their products or services less attractive. To help businesses with their pricing strategies, we're going to have a look at some of the established techniques that they can follow. So, moving on to pricing models. The first one I wanted to look at was what's known as psychological pricing. You'll recognise it when I start to talk about it. It's possibly one of the most commonly used forms of pricing. Dates back as late as the 1800s, but remains effective even to this day. Psychological pricing relies on the strategic pricing of goods and services just below a nice round number. We've all seen this. Maybe a car dealership offers its latest model at £9,999. And how many items are priced at ending in 99 pence? Practically all of them. Many businesses use this trick and we're all aware of it. So is it still effective? Amazingly, yes. So even though the price difference is negligible, irrational customers don't round up the price and they do perceive the item to be cheaper than it is and they're more inclined to buy. We've also got the importance of 9 on sort of a similar theme. Unbelievably, most people see a price ending in the number 9 as better value and more cost effective. This simple strategy might seem ridiculous, but it has been proven to work time and time again. And we've got relative pricing. I think of this as like a race to the bottom, especially in the online world. Ensuring your price is relative, i.e. competitive to the rest of the market, can be key, especially with the emergence of price comparison sites. But knowing how much to charge relates to several factors, one of which has to be how much a competitor charges. However, this shouldn't be the be-all and the end-all. Constantly trying to charge less than a competitor, it's going to squeeze your margins to a potentially unsustainable level. And it could lead to some consumers thinking of your product as inferior as well. So it's at this point, we might want to reconsider how your product or service is marketed. You may decide you want to be a premium brand, such as Aston Martin, or you might want to go down the economy brand route, such as Ryanair. And your marketing efforts should then reflect that business decision. Contextual pricing. So sometimes a price is justified by lots of different factors. It's not just the service or the product on offer. People will happily pay thousands for a Rolex. It tells the time just the same as a £5 watch will do the same. The products fulfill the same role, but there are other forces at play that determine the price. Snob value, keeping up with the Joneses, for example. And the same applies online, and sometimes it can be down to things beyond the price. Even look at the website or the services offered alongside products can make a difference in how much is charged. A business should therefore look at the non-product/service charges changes it can make that will justify a higher price. So you could be different. When choosing a service or selecting a product, customers will rely on their own opinions of the product, which are entirely subjective, but they also rely on price, which is objective. Prices for similar or identical products can be easily compared and may be a determining factor. Where prices are identical, this can complicate the purchasing decision of customers, forcing them to rely on a subjective decision, which may mean that they don't decide to purchase anything at all. In sales, this is referred to as analysis paralysis and means both businesses lose out. By purposely pricing differently to a competitor, you give customers a simple choice if they like or require the same services or product equally. This can help to ensure a sale, although it may not always be in your favour. Offering choice. Research has shown that by selling 3 products alongside each other, you subconsciously push customers towards the middle product. Therefore, if you strategically make the mid-price product more expensive, you can increase your average order value. The savvier online seller can also use this technique to develop a mid-priced offering that's more cost-effective and therefore more profitable. And I think I fall for this myself when researching triathlon bikes. There's always a ridiculous expensive top-of-the-range version that I dismiss before settling on one of their mid-range offerings. I'll definitely not mention any prices there in case the wife's listening. So, moving on to the common thread. All of these pricing strategies rely on the way that customers perceive price and highlight that it could be one of the determining factors in a sale or order. This means that effectively adjusting your price could help increase sales and improve profitability. In today's modern online marketplace, businesses can't sit back and leave prices static. They need to create a pricing strategy that adapts to the market and the needs of customers. And this can be difficult to achieve alongside the other pressures of running a business. And it's why, as a business expands online, seeking professional assistance can prove invaluable. So the next thing I want to talk about is KPIs and what to keep an eye on. The long-term success of any business depends on how it monitors and reacts to change. Think Blockbusters, Debenhams, Topman, Topshop. This is where KPIs, key performance indicators, come into play. When it comes to tracking your business day to day, there are certain financial KPIs you need to be aware of if you're going to maintain a healthy business and drive growth. The KPIs help you measure the here and now, but may not always show you unexplored opportunities or a longer term picture. So besides tracking the KPIs that help you measure performance today, look at the following KPIs to plan for the future. Financial KPIs will vary from business to business, depending on your goals, but businesses should keep these 5 elements in mind. The first one, revenue and turnover growth. Sales growth is one of the most basic yardsticks of success for any business. I know so many clients that chase the next milestone in turnover at some point. Might be 100 grand, £1 million, £10 million. They all do it though. Sources of income. You should also analyse your revenue streams, including revenue per client, to determine profitable customers and segments so that you can make informed decisions about your investments. Revenue concentration. What I mean by this is you need to ensure that you don't have all your eggs in one basket. If all of your work comes from just 1 or 2 clients, what happens if they fail? If this is already the case, start looking now at diversifying your client portfolio to protect yourself. Profitability over time. By tracking your expenses and income, you can then compile profit and loss reports that analyse your business performance over a period and may point out lost opportunities or unnecessary expenses. Working capital. Working capital is the cash that helps to fund your day-to-day operating costs. This can be used as a buffer to tide you over when clients are taking forever to pay you, or to capitalise on work that helps your business grow. So planning ahead. Within my maiden presentation, We've covered a lot of points in detail, most of which focus on the monitoring of your finances and the benefits of having a clear picture of your company's health. But to be honest, on their own, they aren't much use unless they're used alongside a plan that helps your business to grow and prosper. So at the time of this recording, future planning may seem like an impossible task. But if you're armed with the right figures and data, you should be able to invest and adapt with a greater degree of confidence. I can understand why some businesses are choosing to do nothing. They're just happy to survive. But by not taking action, these companies do risk losing out to the competitors who are willing to take things further within their business strategies and analysis. Having a strategy may well be the difference between success and failure in 2021. But just ensure that it's as flexible as it needs to be, and that with the data and insights you need to be able to adapt and remain agile. Thank you for your time, and well done if you got this far.